Good day everyone, I am Mary Nina Uy and I am here to report entitled Financial Statement Analysis. So what is financial statement analysis? Financial statement analysis is the process of analyzing a company's financial statements in order to make business decisions. Or it is the process of reviewing a company's statements to gain an understanding of its financial health. The goal of financial statement analysis is to equip a business with the knowledge it needs to make effective decisions. It evaluates the past and projects a company's future performance. Investors, shareholders, managers, and other interest parties review financial statements for different information. Financial statement analysis is used by internal and external stakeholders to evaluate business performance and value. In internal, it is a constituents use it as a monitoring tool for managing the finances, while the external stakeholders use it to understand the overall health of an organization as well as to evaluate financial performance and business value. Overview of financial statements. So we have the 4 key of financial statements and there are balance sheet. So the purpose of the balance sheet is to present a summary of the asset owned by a firm, its liabilities, and the net financial position. When we say net financial position, it can be equity at a given point in time. And when we say a given point in time, there's a specific date. The second one is income statement. It provides a financial summary of a company's operating results. So what are the elements included? There are revenues and expenses during a specific period. And the third one is cash flow statement. It provides a summary of the firm's operating. When we say operating, we have revenues and expense. Then it has also it is a cash inflow and outflow. Investments, we have assets, and financing, we have a liability and equity. Cash flow and reconciles them with changes in its cash and marketable securities during the period. And the last one is statement of retained earnings. Reconciles the net income during a given year and any cash dividends paid within the year. Then it will also show how much the amount of retained earnings between the start and the end of the accounting period. Analysis techniques, where it used to conduct financial analysis. So the first one is horizontal analysis. It is the technique for evaluating a series of data over a period of time to determine the increase or decrease that has taken place, expressed as either an amount or a percentage. It is a comparison of a company's financial results across time. So I have an example here. So, para masabdan ninyo, kailangan ninyo i-minus ang year 2 sa year 1. Muna makuha na ninyo sa peso amount nga 300. Unsa ang pagkuha sa 300, i-minus na to ang year 2 sa year 1. So, 2,400 minus 2,100 is equals to 300. Dayon, unsaon naman po nato pagkuha ang 14.3%. Ang pagkuha sa 14.3%, kailangan ninyo i-divide ang 300 sa 2,100. So, equals 14.3%. Pero, if i-compute jud ninyo ang 300, i-divide ninyo sa 2,100, pag-compute ninyo, ang mugawas dira is 0.1428. So, kailangan pa na ninyo siya i-multiply og 100 para makuha ninyo ang 14.3%. Usabo na to ha. Ang first step is i-minus ang 2,400 sa 2,100 is equals to 300. And then, 300 divided by 2,100 is equals to 0.1428, and then i-times ninyo sa 100, it is ma-equal siya og 14.3%. So sa ratio na ta, unsa pagka sa ratio, dapat nimo i-divide ang year 2 sa year 1. So 2,400 divided by 2,100 is equals to 1.14. So kung makutana mo nganong naay negative sa percent, it is because negative man pud ang peso amount, so that negative pud yung percent. So ang pagkuha sa total assets kay i-add ra ninyo ang total current assets, long-term investments, and total property and equipment. So pag ma-add na ninyo ang 100,500 and 1,500, and then 258,000 is equals to 360,000. And then also sa year 1, i-add po ninyo ang total current assets, long-term investments, total property and equipment. So sa peso amount, dili na ninyo kailangan i-add ang ang total current assets, long-term investments, and total property and equipment. Kay ang pagkuha man gud aning 27,450,000 is katon nang giunsa nato pagkuha diri ang peso amount, percent, and ratio. Katon nang i-minus nimo ang una ang year 2 sa year 1. So mo nang 27,450 ang result, and then i-divide nimo ang peso amount sa year 1, mo nang may mo siya 8.3%, and then pagkuha sa ratio nga 1.08, kay i-divide nimo ang year 2 sa year 1. So the next one is vertical analysis. So is a technique that express each item within a financial statements as a percentage of a relevant total or a base amount. It is also a comparison of financial balances to a base account from the same company, and or compare against other companies in the same industry. As you can see in the table, the 100% is the net sales. Okay? It is the base. When we say base, that's where we divide all the components. So for example, sa table, as you can see nga ang 100% dire is ang net sales. So kanita na dire, i-divide na ninyo siya sa net sales. Okay? For example, 182,790 is i-divide nimo siya sa 261,000 equals to 70.0%. And also sa year 2, which is 169,050 pesos, i-divide nimo na siya sa 246,000 equals to 68.7%. And the rest, mora Japon inyong buhaton. Ang kaning 78,210, i-divide mo siya sa 260,000 equals to 30.0%. And then also, there is sa year 2, 76,950, i-divide mo siya sa 246,000 equals to 31.3%. So, sila tanan, i-divide ra na ninyo siya sa net sales. So, the last one is ratio analysis. The ratio are designed to show relationship between financial statements accounts. It's a comparison of different balances from the financial statements. Ratio are grouped together to assess a company profitability, ability to pay debts, and survival in the long term. For instance, Company X might have a debt of 5 million and interest charges of 400,000, while Company Y might have debt of 50 million and interest charge of 4 million. The question is, which company is stronger? So the true burden of these debts or the company's ability to repay them can be ascertained. So magkano yung utang, magkano ang interest. By comparing each firm's debt to its assets, and by comparing the interest it must pay to the income it has available for payment of interest. Because when you have debt, you must have enough assets to be able to pay the debt. If you have interest, you must have enough income to shoulder the interest expense. So it is called ratio analysis. And that would be all. Thank you.